That's why it's a bigger number, because most of our capital comes from common stock. So that's how we do. So what are the factors that affect the company's WACC? There are some things that are uncontrollable. They're outside of the company, like the market conditions. It could be interest rates. It could be the overall economy. Second is the market risk premium. Over time, the market's risk aversion may change, and therefore the risk premium may change. And finally, tax rates. We use 40%, but that's a determined number based on the federal tax rates, which is essentially politically determined by Congress. And the controllable is what we can do inside the company. Capital structure, which means how much debt, how much equity do we use, and if equity, is it preferred equity or common? Next is dividend policy. We could choose to keep all the money in the company, and that would then change our need for capital. Third is investment policy. How do we make investments with our excess funds? If we continually take on more and more risky projects, then the risk will be reflected in the assessment by our investors. Then they will demand more if we're constantly doing very risky things. Conversely, if we make very safe and conservative projects that have good payoff history, then the investor would be more comfortable. Therefore, the cost of borrowing may decline based on the bond ratings, and also based on the beta and the expectations from the marketplace. So we have computed the WACC at a company level. Now, what if the analysis is at a division level within the company? So here we would look at a couple of different ways to estimate the proper rate of return. First, why do we bother with a different WACC for a division versus the company? Well, not all projects are the same, and not all divisions have the same amount of risk as a company as a whole. So it's important to modify the WACC to reflect the level of risk and the returns necessary for that particular project or division. So let's stay at the division level. We could derive a beta based on the historic ROA from that division compared to the company, and therefore the market by inference. The second way we could do it is look for what we call a pure play. An example of a pure play is where there's a publicly traded company that happens to be in one line of business, and that one line of business matches the division's business. So let's say we have a multiple line of business company, and one of the divisions happens to be in the retail home improvement hardware business. So a pure play might be Home Depot. It is a publicly traded company. It has all the financial measures, beta, etc. And we could then infer or assume that the beta for Home Depot is going to be the same as the beta for that division, which happens to be in its same business, retail home improvement. So that is using the pure play method. We can look a little more closely at the accounting beta for the division, and we would run the ROA for a division or project against the S&P, and then find what that correlation might be, and therefore see if the rate of correlation generates more meaningful results than a pure play or the company WACC. So here, instead of measuring a rate of return of a company versus the S&P rate of return, we're regressing the ROA of a project or division compared to the ROA for the S&P. And this is a method if we can gather sufficient data to make it statistically significant. Here's an example of how we might compute the divisional cost of capital using a CAPM model. On the left side, we have the given data, target debt ratio of 10%, which means the equity is 90%, the required return on debt of 12%, the required return or the risk-free rate of 5.6%, tax rate of 40%, beta for the division determined either from a pure play or the inference from an S&P ROA method is 1.7, the market risk premium of 6. So on the right side over here, we see the computation, and it's just like what we've done in CAPM all along. Take the risk-free rate, 5.6, plus beta times the market risk premium, so it's 1.7 times 6%, and we end up with a number right here of 15.8%. So that is required return on the equity portion. Next is we do the WACC, but again at a division level. So we weight the target capital structure of 90-10, and we use the cost of debt, 12%, times 1 minus tax rate of 0.4 to get 12 times 0.6. And then we carry forward this 15.8 from above, which is the required return on the equity portion, and we end up with 14.9% for this division. Notice that the division WACC of 14.9 could be different than the company WACC of 10.4. In this particular case, the company is less volatile or has different capital structure, and those two would contribute to it having a lower weighted average cost of capital than does the division. And so here we would say, if we put a more stringent hurdle on the division project, like a 14.9, if we can beat that return as a hurdle rate, then we're clearly in good shape, because not only is it above the divisional WACC, it is clearly above the company WACC. So we can think through even a more structured progression of a firm or company's WACC, then moving to a division, then moving to a project within the division. And here's we look at risk. At a project level, a specific project has different risk, and it may be even within a given division. So there's some types of risk that we can then hopefully quantify, or at least get orders of magnitude impact. There's standalone risk, which in the project in and of itself. There's corporate risk, which is for the company as a whole. And there's market risk, what would happen based on the reception of the market or the competitive reaction. So when we use a project risk-adjusted cost of capital, we would start with the divisional, and then we would, one quasi-scientific art and science approach is to then adjust it upward or downward based on a judgment on whether that particular project is in general more or less risky compared to the division as a whole. So this is application of some science in the determination of WACC and some art in adjusting that WACC based on your judgment.